Welcome to the Market Pulse podcast from Equifax, where we break down the latest economic and credit insights to help you navigate today's business landscape.
Welcome to the Market Pulse podcast. I'm your host, Emmaline Aliff, leader of the Equifax Advisors. The Equifax Advisors align strategy and execution by translating economic and industry trends into practical Equifax data-backed insights and stories. We equip executives with data-driven narratives to make clear strategies, clear strategic and tactical decisions. In other words, we don't just study the economy, we operationalize it for a competitive edge. And before we kick off, our economist from Moody's will provide an update on the macroeconomic environment.
I'm Justin Begley, an economist at Moody's Analytics. June marked the first Federal Open Market Committee meeting for Kevin Warsh as chairman. The committee left the Fed funds rate unchanged at 3.5 to 3.75%. An updated summary of economic projections show that an improved labor market and accelerating inflation have taken rate cuts off the table and pushed policymakers' projections for the Fed funds rate higher. The prospect of policy tightening triggered a negative reaction in financial markets, pushing short-term Treasury yields higher. The median FOMC member now expects 125 basis point rate hike to be appropriate this year. In March, the median projection was for a quarter point cut. The median Fed official forecast puts PCE inflation at the end of 2026 at 3.6%, up from an expected 2.7% in the March outlook, as the fallout from the energy price shock from the conflict in Iran will take time to dissipate. Core PCE, which excludes food and energy, according to the median projection, is expected to reach 3.3% in the fourth quarter of 2026, up from 2.7% in March's SEP. Meanwhile, growth projections were modestly revised downward as the U.S. economy remains largely resilient, even amidst the global supply shock. Our June baseline forecast removed the rate cuts that were previously penciled in for the end of 2026 and early 2027. Instead, we assume that current policy holds in the near term to immediate term. Tariff inflation has made its way through to consumers, and the worst of the energy shock's impact on headline inflation is expected to be concentrated in the middle of this year. Consumers are still spending, which is good news, even amid elevated cost of living pressures. And the labor market is showing more signs of life than it had previously in the year and much of last year. These dynamics have taken any policy easing off the table for this year. Even as they do pass, however, the productivity gains from artificial intelligence will likely lift the neutral rate by 2028 and, absent any other shocks, diminish the need to ease monetary policy further.
Welcome to this month's edition of our Market Pulse podcast. We're here to talk about the macroeconomy and specifically the things that we've been studying around Market Pulse Index. Before we jump into the questions, we've had a lot of things going on this summer. In our team, we talk a little bit about the World Cup. What's been on your minds with some of the latest things that have been happening in the sports world?
Do I have to keep that just to the World Cup, or you did say sports world? Because
sports world is fine.
If it's broader, then I'll brag on my Washington Nationals, and by brag I mean that they're somewhat respectable for a change, which is for a Nationals fan that's huge. Not seeing them at the bottom of the standings is something I'm still getting used to. But as far as the World Cup is concerned, Ireland and Italy didn't make it, so it's all focused on the U.S., I guess.
Yeah, I watched the Spurs closely, the Spurs and the Knicks in the NBA, and that was pretty painful to watch. So I'm following the World Cup. Hopefully the U.S. will do well, but I'm still a little bit pained by the performance that the Spurs had.
Yeah, it's been kind of fun to watch all of the culture from the World Cup to me. Like with I enjoyed like the parades, like the Scottish audience was having, and then how they were like chanting at other venues and things like that. It was quite fun and interesting for me. And I did go to the Braves game recently. I was there on Pride Night, which was really a fun experience.
I did read about the consumption of beer, so it would be interesting to see if we see any like indicators in our GDP or in our consumer spending with respect to beer. I think it sounds like the Scots have drank all the beer out of Scotland and out of
Boston, I think it was.
Yeah. So should be interesting.
That's quite a feat. I guess to pivot a little bit back into the macro environment. We oftentimes will talk about like what's happening from a vibe perspective or data perspective. Jesse, when we think about like when we hear in the news that inflation is sticky and top line economic indicators appear to be stable and the quote unquote vibe on the street feels a little tight, why are traditional lagging indicators like GDP or other things potentially missing parts of the story of the U.S. consumer right now?
Yeah, so I think it's a classic case of what everybody's calling the vibe session. I think if you think of us really with the role that we play with business economists, we know there's kind of cold, hard math behind the vibe. So when you look at traditional indicators like GDP, they're a good source for telling us maybe where the ship was 3 to 6 months ago. They're a little bit weaker at exposing the holes that are currently forming. When you think of the top 10 or 20% of the economy, increases in their spending is significant because it's spending and it's being backed by assets that are booming. Top line GDP then looks incredibly stable and healthy. But for the average, you're seeing that it completely masks the micro stresses that are happening across things like grocery checkout or gas, at the gas pump. And that's like the other 80% of the population. And so, I think it's really indicative, like GDP is telling us that money was spent, but it doesn't really tell us how life was financed. And so I think it's really a question of then if we're seeing that it was financed out of rising wages or if, our households are having to tap into dwindling savings. That's really different than just an average that's kind of consistent. And so that's why I think that indicator of GDP, it's a great measure, but it's one that we kind of have to watch and look at the nuances behind it. And that's really what we did when we built Market Pulse Index.
Yeah, Jesse, you used an analogy that I think you probably read from somewhere else, but I thought it was extremely clever. Like if you have an individual whose head's in the oven and his feet is in the freezer, the average is normal body temperature, but that doesn't really tell the story that individual is in. And I think, to your point, looking at a single macroeconomic number, whether it's GDP or anything else that's aggregated or averaged, it's obviously missing a lot of the detail of what's actually happening underneath.
Yeah. Thanks, Tom. Now I got to come up with another analogy.
I'm sure you could come up with one.
I'll come up with something good.
One of the things that we oftentimes talk about is the lag effect. And when we think about a lag effect, we see prices rise, but consumers don't necessarily change their habits immediately. And as prices rise, they may spend less, but their cash flow is definitely potentially impacted by that. And sometimes delinquencies could be on the rise. Tom, we're thinking about like lag effect, because I know you've studied this quite a bit. Maybe you can comment on how we try to examine things with through a Market Pulse Index lens to capture and understand those hidden financial stresses about missing a payment, for example.
Good or bad, depending on how you look at it. We've gone through a huge case study of this with the impact of inflation recently, where yes, eventually those stresses caused by rising prices become apparent within a credit score and other measures because people start missing payments. We see balances grow and so forth. But even before then, when you're taking a look at the holistic picture, you see changes in spending. You see changes in savings amounts, in overall wealth. You start to see debt to income shifts as people are relying more on credit and paying maybe minimum balances as opposed to larger balances. And all of this is stuff that happens predictably prior to the things that really have an impact on credit scores, like missing payments or other factors. So when you take a look at that wider range of financial activity, you could start to see where the stresses are building before it actually becomes manifest in a credit score or on your lending portfolio.
Thinking about those different ways, I know there's a number of things that we've incorporated that we study and have brought into our own macro index. When I'm looking at that, things that, that come to mind, like capacity or assets, are, examples. But when we think about, what are we looking at? What have you found to be some of the most interesting and relevant things that indicate consumer financial health as it relates to each other?
Yeah, especially recently with the stresses that we've seen from rising prices and affordability being a huge obstacle for a growing portion of the population. Really what it comes down to overwhelmingly is access to liquid wealth, savings, investments that can be drawn upon, not 401ks that are pretty much tucked away, but things that when prices go up, when emergencies come around, or even planned expenses that come in higher than you had originally planned for, being able to draw upon those savings, those assets is huge. And we see that very starkly within the populations, those populations that have those assets that they can draw upon and have been drawing upon over the last couple of years. They've been thriving. They've been able to adjust to the rising prices and even grow because they're seeing equity growth and their wealth grow accordingly. On the flip side, those populations that don't have that financial safety net, that ability to go back and draw upon resources when needed, they've been struggling, and we see that reflected in the data.
Yeah, Tom, I think when you were talking about the types and breadth of data, it brings me back to the notion or idea of a balance sheet. If you think about the average household, and you think about, does this person, have they paid their bills in the past on time? That's a question I think we're all really good at answering, in the risk management world with the data that we have. But I think with the focus of Market Pulse Index, it's really, does this person have that financial runway to survive the next economic shock? And I think when you put that into the context of looking at the consumer balance sheet, so looking at credit, looking at income, debt, assets, capacity, et cetera, I think you get that notion of what the value is really of a Market Pulse Index. It's really getting that specificity, on a household. Can they survive that next shock? And that's really what we do. That's our job.
Thinking about it, there's of course things that matter across the different dimensions, but liquid wealth, the ability to generate income from a cash flow perspective, and essentially that allows someone to be able to cover their payments and have favorable debt service ratios. Thanks for putting that into some context, especially when we think about we do talk about a lot of the various components, but there are things that definitely have a prioritization in terms of the ability to withstand things, or even move into the term you used was thriver, Tom. So
right.
And I know that's one of our segments that we've been referencing. Right. So changing gears a little bit, I was kind of latched on to the analogy that y'all were using about the temperature of the oven and feeling just fine. So let's unpack the K-shaped divergence. I know that's the word's out there often, and I know that's one thing that you're often times talking and thinking about, Jesse, is when are we not in a K? Are we in an E? Are we in a B? Or are we in a
definitely
whatever shape the economy might necessarily be? But some of the recent data shows that the national perspective on Market Pulse Index, I think the report at the end of the year was 61.6. Maybe you can talk about where we currently are and how things are sitting from a stability perspective, and specifically what the potential illusion of the average could be.
Sure. Yeah. So I think we're somewhere in the 60s, mid 60, like 60.6 maybe is the latest number. But you bring up a great point. I mean, I think it implies that there's stability in the middle class. But, like Tom had said, we talk about averages. We love to joke about the averages, whether we have our head in the oven or not. But I think the picture really then of like this macroeconomic stability, it shows that there's kind of this calm surface, but there could be, more volatility behind the base. And so I think when we look at that average of being 60, it's being propped up by the top end of the K, the top arm of the K, the one that we call
like
thrivers.
10%.
Yeah, exactly. Yeah, exactly. So those are consumers that are growing their wealth or pulling the index upward. But at the same time, you have this bottom arm of the K, and that's sinking under the weight of this persistent inflation and the high debt services. It's really pulling that index down. So when you pull equally from both ends, it's like the middle's not moving, but in reality, the middle's tearing. You see this, this divergence. And so I think relying on that average right now, it's, probably a recipe for the suboptimal business decision, really, because nobody's actually living in that average. You're either kind of on that upward trajectory or that downward trajectory.
Yeah, I think that last point you made is a particularly good one that we rarely touch on, or at least we touch on less. We talk about how the average doesn't tell the full story, but I think very closely related to that is that average describes less and less of the actual population, and that's critical because that average quote unquote population is where the financial lending industry has really focused a lot of attention on. That middle class, that average consumer. Well, there's less and less of that average consumer. There's more going up, there's more going down. And, so that average actually describes less of the population and doesn't describe a growing portion of the population.
Yeah, what I heard from the one-liner there is we've seen a 1% drop. If I got the overall stats correct from what Jesse was saying, 61.6 to 60.1.
Yeah, 61.6 to 60.9, I think is the
1% total drop.
Yeah.
So I think that we've seen an expansion of the bottom ends, and what I'm curious about then when we think about that, different angles of divergence and the speed with which things can either move down or up, or even come back down on the upper ends. Because I think in our last report, we were showing that the top 10%, the thrivers, grew by over 30%, and the middle shrunk by 6% over 18 months. So when we think about that, Tom, I'm curious, do you think we're in a permanent polarization of American consumer finances? Yeah.
So is the K permanent, or are we? Yeah. That's a fascinating question. It's actually one that I've been thinking about a lot, for a while now. And I did a bit of research, and by a lot of measures, you can go back all the way back to the 1970s and say that's when the American middle class really reached its zenith. That was that was where. The middle class was where the financial strength was. But starting in the 80s, we started to see that divergence start happening. We started to see the growth of of both the populations that were thriving and those that were struggling. And off and on, that's been a pretty consistent pattern really for over 40 years now. What's been noteworthy in the last several years, starting with COVID, is the rate at which that divergence has grown, and that's why this structure, this phenomenon that's been happening for over 40 years now, is really becoming a headline topic again. So permanent, I wouldn't say anything is permanent, but we are definitely in a very long-term phenomenon happening here.
Yeah, I'm curious about things that are pivoting and shifting about that, because I know, we oftentimes will think about what makes up the thrivers, what makes up the striver population, what are some of the things that potentially changed. So, Jesse, when I'm looking at that top 10%, the thrivers, what do you view, or what would you share as protecting them more right now?
I would say if we think of the analogy as protecting, then maybe I'll use the analogy of a shield. And so as we think of the thriver population in a high inflation environment, when you think of income, income is definitely a shield. Let's make the analogy, it's made out of wood, so it's strong, but it may not be quite as strong as assets. And so assets are made out of, some stronger metal, if you will. So if you only have high income, I think inflation can still erode that purchasing power, and it makes you feel squeezed. But when you think of having accumulated assets, you think of having home equity or market investments, you're more insulated. So when you think of the 20+% growth in the Thriver tier, it's really fundamentally driven by an asset story. And so as we think of, that population has a lot of home equity, they have fixed rate mortgages, they're actually benefiting as rates go up. You think of the assets that they have that are fixed income derived. And so I think, as the Thrivers go to buy groceries or they pay for insurance or they pay for anything else, they're solid in knowing that they have that net worth, they have that background. And I think that changes their consumption habits and it changes their behavior much differently than somebody who doesn't have that asset or that shield to protect them.
Jesse's on an analogy roll these days.
I know. That's it. I'm done.
You're done? All right.
No more.
Can I borrow a few?
Until the next topic comes along.
Yeah, there you go.
Yeah, but I think that's really really helpful, especially when we look at like the key things that are we talk about the K, but you offered a bit of insight in terms of how the equity markets have been flowing and various bifurcation of even savings rates that the
Absolutely.
top end has been able to accumulate savings and equity, which has really been a key driver there, which of course, we've talked about this often, is that will oftentimes, if the stock market's doing well, even if someone's not accessing it, they're more likely to go out to a nice dinner on Friday night.
Absolutely. Yeah. And it's a big focus right now because savings rates are, historically low, 2-3%. And that's a concern, obviously, probably more so on the bottom end of the, low to middle income households, but certainly, it definitely does matter.
Changing gears a little bit, I want to talk about the generational divide and the movements that we've observed there. Now, I don't know what your new grandchild's generation is going to be, or are they Gen Alpha, or is it in the next one?
I think we're in Gen Alpha. Anyone born now is Gen Alpha, so
okay.
I'll have to look that up to be sure.
Well, but we do know that Gen Z is credit active and they've been emerging in this space. In our last report, we saw that Gen Z grew by a massive, when we talk about that top tier, they grew by 74%. Now, some of that, of course, could be size of the population or other potential things with respect to a lot of variability within that group as well. Maybe you can shed some light on why we think that the split seems to be more dramatic into the haves and have-nots, and what are some of the things behind that? Is it their careers? Is it other things? Like what are some of the key drivers behind that growth that we've observed there?
That is so millennial of you to want to talk about Gen Z. So, but I do agree, Gen Z is fascinating because they are the up and coming financial generation. I mean, they're the generation of the future, not surprisingly. And you're right. There is a huge degree of variability within there, and a lot of that is what you would expect. And any time that a new generation becomes of financial age, you're going to have a wide distribution of how they're starting those financial lives. Their incomes are going to vary widely. The amount of wealth that they have, will start to grow rapidly or not grow at all. And so you'll see a lot of disparity or variability across generations that over time, when we look at previous generations, that variability has tended to shrink. And we see more, confluence around the mean. But with Gen Z, they are in a bit of a unique situation. There is a lot, as you said, a lot of growth on the top end of that generation, as well as on the bottom end, more so than the other generations. And some of this is because some of them are walking into their financial lives in great shape. Other facets are in play as well, though. Some of them have access to family wealth. Some of them have very different situations at home and convenient safety nets that they can draw upon. So that's a different factor than we've typically seen in other generations. So it'll be interesting to see how that plays out over the years ahead.
Yeah, that's really interesting, especially thinking the emerging careers, but also if someone misses a bill, it is helpful to have a generational backing of some kind, or
Mm-hmm.
at least in a neighborhood, um, or some kind of community.
Thinking, Tom, about what you were saying with respect to the Gen Z, looking at the conference board data recently, I noticed that when you looked at generational breakout of that data, and it really tracks well to Market Pulse Index, but when you look at that conference board data, it really it showed that Gen Z, specifically Gen Z and millennials, both had some of the highest confidence in the economy, which it just runs counterintuitive to me to some extent. But I think as we were talking about it, it does make sense. You have that buffer. You have, even to some respect, Gen Z, I think, having a little bit different fiscal discipline than maybe some of the other generations, even millennials, compared to millennials. So kind of interesting to see that data.
I know it's popular to rag on the millennials and Gen Z, but as a firm Gen Xer, I like looking at the data and telling it as it is. And what I see there actually does give me a lot of confidence. There's a lot of there are a lot of signs that say that Gen Z as a whole, obviously individuals are different, but as a whole, there's a lot of financial soundness as they approach the beginning of their financial lives. It's encouraging on a lot. Now, I don't envy them the timing of their entering financial lives. They have not chosen a good time to start careers and start trying to build wealth. But with what they have to deal with, they're as a whole doing pretty well.
In my notes, I have 4 more things I want to talk about. So we can count them down. Thinking about that, the younger generation, we know that they're not the only generation that is in the market. And I know we still have not forgotten about the Gen Xers, Tom. And
Everyone does.
I think I'm gracious that you classified me as a millennial, even though you know how old I am. But when we think about the on the upper end, I really liked how you shared about some of the things you were observing in the data from like the 70s onward, and that's like if you think about who was of age at the time. To the boomers and traditionalists really having and we know that they do exhibit higher index scores on average. Some of that is accumulated wealth. How much of that is potentially distorting the national average when we think about the other end of the distribution? And now by distortion, that doesn't necessarily mean that others may not catch up, but we know that things have changed over time.
Yeah, absolutely. So I do think to your point, we see with boomers and traditionalists, they have some of the highest Market Pulse Index values, call it mid 60s, 64, 65. Mm-hmm. And I think when you realize that those two cohorts specifically hold some of the vast majority of the nation's housing equity, they have large wealth portfolios, you can see how that's going to distort the national average. They're largely immune to mortgage rates when you think of having houses that are either owned outright or fixed on lower rates. And then they also hold fixed income. And so you can see that higher yields are going to impact positively those fixed income assets that they hold. I think it really shows that there is a true impact to the average overall and really a skew then as a result of that. When you look at the macro data, at total spending or at an aggregate level for financial health, I think it's skewed then by that older generation actively spending down those retirement assets as well, so sort of depleting those assets. So I think there is somewhat of a false narrative then in terms of overall consumer health when you think of in the context at least of what we're talking about with how boomers both accumulate assets and then how they spend those assets.
Yeah, and I think part of that is something that we would see any time we have generations getting older. Is you simply have time on your side and the ability to accumulate wealth over time for a large portion of them. But I think one of the fascinating aspects about these particular generations that we're looking at is the potential for the wealth transfer that is starting to be on everyone's minds, as we look ahead and we start to see, okay, as the boomers and beyond, continue to age out, how much of that wealth comes down to the younger generations, and what type of impact does that make that we haven't seen before on a scale that we're looking at? So that's going to be something that'll be very closely followed in not the years ahead, even the months and quarters ahead.
All right, you experts. What I want to do then is we've been talking a lot about the macro stuff, about the trends, about things that we've been observing in the data. But to come back to your analogy perspective, I'm in the Equifax Advisors. I'm not a lender or a retailer, but imagine that I am. When we think about that, Jesse, maybe you can weigh in here, and then I'd love your perspective too, Tom. I'm going to ask you, how do I find resilient consumers in the shrinking middle in particular? Because if I think about that, I tend to have a perspective on where the top end might be going, where the bottom end might be going. Now, studying that middle is critically important, but how do I find them?
Yeah, it's a great question. It's something we talk a lot with customers about. So I think we're in a golden opportunity right now when you think of where lenders and retailers are right now, finding that middle class is shrinking. You can't just paint the remaining middle with a broad brush. So if you rely solely on, let's say, traditional credit scores, you might see a consumer that's dropped 30 points, but it's because their credit card utilization ticked up. And that's due to inflation. And so risk models are going to say no, but if you look through the lens of something like Market Pulse Index, you're going to find that the consumer has stable, verified income. They have strong employment capacity. They have significant home equity. And so that score dip is really, it dipped due to, a short-term cash flow management issue, but it's not a structural issue. And so I think that hidden risk is where the sweet spot is. It's really allowing lenders and businesses to find that resilient, upward mobile consumer, and then they take advantage of that pivoting middle, and they safely extend that credit or service to them. And I think that's the key, is really finding that hidden risk in that population, which is what we've really designed Market Pulse Index to do.
And I would say even you used the term traditional metrics, Emmaline, when you were talking about that. Even those traditional metrics are changing to a degree. And an example that I use for that is simply the usage of time within there. Traditionally, credit scores, take as an example, have been point in time. Like, what does Tom O'Neill look like right now? What is his debt? What is his performance? Is he delinquent on anything? What are the open lines of credit that he has? All of those factors. But Jesse used a great example with rising prices. Like, I might be in exactly the same strength of financial in my financial life as I was previously, but because the items that I'm buying are more expensive, my balances are going to be higher. I'm still paying it off each month. My fundamental situation has not changed, but the formula, that model, is going to see, his average balance is now $1,200 as opposed to $1,000. And it'll weigh that accordingly, and my score would be impacted. And it's missing the point of the fact that, yes, my balances have changed, but I'm still making those payments. My income maybe has changed. And so that's where, to Jesse's point, looking beyond that and seeing these different facets, are my savings dwindling? Am I still able to meet my obligations without getting myself under financial stress? That's where the larger picture comes into view.
So then to continue on that, what I'd be interested in thinking through is, say, for example, to be reactive or proactive is probably a thought that many lenders would have. It's what I would be thinking about, is what are the activities I can do proactively? What are the things I can do reactively? And when we think about that, I love how y'all were talking today about specifically like taking an economic metric like inflation. How does that carry through to cash flow? And then cash flow, how does that carry through to all the things that someone would be able to withstand any modification to that cash flow. So, like, are there ways that someone can front run, the idea of risk before a bigger, I don't want to say like crisis necessarily, but if your portfolio, starts performing more poorly than you expected?
Yeah, how could you be more proactive than reactive? Yeah.
Mm-hmm.
And we could stay on the Market Pulse Index topic for that matter. We used some examples earlier where, because that index is taking the more holistic view, it's going to catch things that a single credit score or some other type of risk score is not going to necessarily account for. But more importantly, in terms of actually taking action, is it doesn't just tell you, hey, there's more stress over here and less stress over there. It tells you why there's stress over here. So it's not, this population we've seen have their average Market Pulse Index score decrease. Okay, that's interesting. You've got my attention. Why has it decreased? Is it because, their incomes have been stagnant, that they haven't been keeping up with the rising costs? Is it because they're taking on more revolving debt? Is it because their savings, their wealth and assets are taking a hit? The answer to those questions are what drives those proactive actions that you can take. And because the index can say, here's why their overall score is being impacted, you could then pull upon the different data assets that Equifax and others offer to take that action and say, all right, let me zero in on this particular area that the Market Pulse Index helped identify.
Since you two challenged me for another analogy, I think the fact that Market Pulse Index really switches from reactivity to proactivity. I think because we're looking at the intersection of debt, capacity, and assets, we're really spotting the micro, like if you want to call it a fissure, we're looking at the fissure more than the tectonic shift that's happening for the earthquake, and I think that's the value there, is really finding that fissure that starts. And that's how lenders are going to, they're going to use this data proactively to find those small faults before it turns into a bigger issue.
Okay, so I'm adding that to my list of Jesse analogies. So we've got oven, we've got shield, now we have earthquake.
I'm on a roll. Roll.
Yeah.
So I did see there's a ladybug that's walking across my window right here, and I know that there's a lot of symbolism around ladybugs, meaning like good fortune, luck, protection, like all the things, right? That you described. So what I'm curious about, especially with what I wanted to close out on with all of you, is what is your prediction on the U.S. consumer over the next 12 to 18 months? And would you dare to venture?
Oh, you're asking us to make predictions? That's risky. We could go all over the place with this, but let's take that on. I think it all boils down to the health of the consumer, and that's not earth shattering. That's not an Einsteinian brainstorm right there. But it is the case. When we look out across the macro environment and we see what is going to make financial life easier or harder for the vast majority of individuals, that's where the focus needs to be. And so starting right off with the headlines of oil, if that resolves itself, we know that even if there's an agreement that we're not going to have oil prices come back to what they were overnight. But if there's one scenario that the strait is opened, oil prices start coming back into play, supply chain quagmires start working themselves out, and we see the end of the tunnel in the near future, that's a healthy scenario. If that doesn't hold true, and we start to see consumers on a large scale be even more impacted than what they have been, then we're going to have a very different, Christmas in 2027 than perhaps we had in 2025.
And I think I'd add, since Tom took the prediction part, maybe I'll just call out one potential hidden risk and one hidden opportunity. I'd say for a risk, really looking at the remainder of the pivoting middle population. So again, that 70% of the population that we talked about with Market Pulse Index, understanding that those households have, they have challenges. And so maintaining their lifestyle, they're using credit, they're using savings. So what happens with the labor markets? Are they going to soften? If they soften, what does that do in terms of unemployment and the impact there? On the hidden opportunity side, I think looking at the upper arm, the thrivers, I know we talked about how that population is a smaller population segment, but it's also, upwards of 50% of all spend, I think is what I saw in one statistic. And so really looking at that population and understanding how businesses and lenders, how they market, how they leverage multidimensional data to identify opportunities in that space. I think it's going to mean that precision is a critical need targeting that population.
Well, I loved how you answered my question on prediction with an "it depends" answer.
I mean, you have to know that we're going to. We're always going to walk a tight line.
I love it. Yeah. But it really does depend. And I think so when I'm looking at this, I'm going to be examining the things that you described from economics, understanding the economic policy, how things carry through to inflation, and then tracking all the things we've been talking about for cash flow on the top and bottom end of the market, and specifically where that middle class might be going. So that's all I want to know this time. And I definitely want to thank my panel, Jesse Hardin and Tom O'Neill. There's a lot of information we covered. So thanks to Jesse and Tom for joining me today. And then to you, our listeners, I hope you really enjoyed our topic. If you have any other questions or suggestions for future podcasts, you can reach out to us at advisors@equifax.com. We look forward to hearing from you.
The information and opinions provided in this podcast are intended as general guidance only and are subject to change without notice. The views presented during the podcast are those of the presenter as of the date this podcast was recorded and do not necessarily reflect official positions of Equifax. Investor analysts should direct inquiries using the Contact Us box on the Investor Relations section at Equifax.com.